Many investors begin with just a couple of dollars, and there's nothing wrong with that. That is perfectly okay. But what isn't okay is sensationalizing the idea that you can day trade your way to millionaire status, because the odds are not in your favor. This is exactly the reason why I am building a dividend portfolio, tracking it here on YouTube and investing small amounts consistently. Hopefully, I can have this money, have it grow in 10, 20, 30, and 40 years down the line and not lose it in a swing trade on some small random company that people on Reddit said was going to the moon. Let's dive into this a little bit deeper, explain the title of this video, why I'm not adding any more stocks. Let's go ahead and get right into it. Welcome back to Financial Friends. This is a community of people who love business, finance, and investing. If that is you, if you've clicked on this video, hit subscribe, hit the like button as well. Help us spread financial awareness to the financial friends that make this community. Leave a comment. Everything, of course, revolves around community. Your feedback, your support is crucial to this channel. Let's go ahead and dive into the portfolio that I've referenced, let you know the update, and then discuss why I'm not adding any more stocks. So, I made a $20 purchase of FizzRocks. You can see that position here has grown. Also made a $10 investment buying that dip on 3M. Decided that was the move personally for me. Down 13% in that position. I'm going to continue to build over the long run. And let me tell you a little bit why. And it starts with doubling a penny every single day. This is the classic motivator, the classic example of why compounding works, why you can take a penny and double it every day, and instead of giving a one-time payment of $5 million, you would instead take the penny and allow that to double for a month. Now, a lot of traders use this, and they might assume that something like this is possible. Taking your investment, doubling it, or getting a 100% return, and then continuing to allow that to happen every single day. And I'm sorry to break the bad news to you, but it just isn't possible. There are hundreds of different small micro factors that could add up on any given day to not allow you to get a 100% return. And not to mention, that could happen any day, but doing that 30 days in a row is quite literally impossible. I say not to say anything's impossible, but 100% return 30 days in a row, that is pretty much impossible. Now, you might be sitting there saying, okay, cool, well, maybe doubling my investment every day is impossible, but what about getting like 10% back? I think I could do that every day. You might be able to. However, you run into this problem. A 100% return is a double on your money. A 10% return is obviously getting 10% back on your money. That 10%, if we're assuming that we're maybe starting with a smaller amount of money, like most investors do, it just won't add up in quite the same way. If you had a $1 million portfolio and you got 10% back, you're going to get $100,000 on that investment, but that shrinks by a factor of 10 every single time, to the point where if you have $100 and you get a 10% return, you're getting $10 back. If you're trying to trade or swing trade this money and you get another $10 on your now $110 investment, you're only getting a mere $11 back. My point being this: as you take a small amount of money and get 10% returns on it consistently, which you might be able to do, your money is going to grow a lot slower. And I'm not trying to disincentivize any of this. I'm not trying to incentivize it. Of course, this is never financial advice. But my point being, you need capital to build wealth. This $1 million with a $100,000 return is substantial amounts of money. $10 just isn't going to quite cut it. This leads me to my portfolio, why I'm doing what I'm doing. You probably have noticed, if you've been following this portfolio for a while, I have 10 positions, and I have only had 10 positions for the majority of this portfolio, never going above that number. There's been talks of me adding some new positions here and there, but I have never actually done it, and it's for a very particular reason. Now, of course, I feel that the companies that I've researched and done my research and made bets on, I feel like I like those businesses. I like where they stand in the grand scheme of things. But as I continue to invest in these businesses, I am furthering that bet and increasing the chance that if any one of them does take off, does get an outsized return, I stand to benefit a lot from it. We talked last week about diversification. You want to have a diversified portfolio, but you don't want to have a over-diversified portfolio. What happens there is you spread your capital very thin. Prime example is this return. If we had 10 positions with $10,000 in each of them, we would get a $1,000 return on any 10% shoot up in a stock. But if we spread ourselves very thin and had, say, 100 positions with $1,000 or 100 positions with $100, that return on our investment shrinks again by a factor of 10. And so while spreading our money out might seem like a good idea, spreading it out too much is not a good idea. That's exactly why I've stuck with 10 positions. And I have examples here in my notes. If, say, Apple received a massive year, they had a fantastic fiscal year, the stock shot up, the company was thriving, but I only had $100 in the company at that point, that would not be good. And of course, I only have $82 in it now, but the point being is, with only 10 positions, the opportunity to build my share in Apple, the portion of my portfolio allocated to Apple, stands to be much greater than if I had 20 positions in this portfolio. Same thing as in another example, if John Deere received a massive dividend hike for some random reason. If I only had $100, which again, I only have 85, but this is long run. If I only had $100 in that, I don't stand to gain that much from an outsized dividend increase. But if I concentrate my wealth into these 10 positions within this portfolio, I stand to gain a lot more. The point is, the more you concentrate your positions, the more you build volume in your investments, the more that something like a 10% increase stands to allow you to benefit. In conclusion, it's really this simple. You make research and calculated bets. It's really risk diversification, or I should say risk management at its core. Take as much risk as you possibly can to get the most return, but take the littlest amount of risk that you can to get the most return. You don't want to be over leveraged. You don't want to be under leveraged in the event that your calculated, researched bet plays out the way that you expected it to. So, really in conclusion, you can't risk to build wealth, but you can build to build wealth. I hope this video made sense. I hope I was able to, articulate that point in some way that made sense to you. It's actually quite the reason why 40% of my portfolio is in SCHD. This is a well-diversified position that I feel is going to do very, very well over the long run. And of course, I want to have the majority of my wealth within this particular portfolio allocated to that one specific position. So, thank you very much for tuning into this video. I hope you learned something new. I hope you're able to take something away from it. If you did, as always, leave a like down below. If you don't already, hit subscribe, hit the bell right next to it. That way you're notified every single time a new video from Financial Friends comes out. Make sure to follow on all the other platforms, social medias, whatever they are. Thank you so much. I hope you have a great rest of your day. Take care.